I'm Kaylee. I have been at West for like 5 years now. I think most of you guys probably already know me, but I started out in Fed tax, and I still do some of it, but I've kind of moved into more of a state focus the last like 2 or 3 years. So I got attached to this training for you guys, all about multi-state filing and how we make decisions on state filings. How many of you guys have ever done a multi-state business return before? Okay. What about multi-state 1040s? So this one is more business focused, I would say, just because that's where we see more multi-state issues. With passive entity tax now, 1040s aren't as much of an issue on the multi-state side, so we're gonna be focusing on partnerships, S corps, and C corps with the training today. So the first thing in your book here is just the PowerPoint of what I'm gonna go over. And then there's like some charts and some resources and stuff that I can go over when we get done with PowerPoint. So, okay. So first slide here is just an overview of how this works. So, C corps, taxes paid at the entity level. So I think you guys probably all know this. It works the same as like a C corp Fed return, where you have taxable income, you have a tax rate. So C corps, we don't do a ton of C corps at once. It's kind of the minority of business returns that we do, but essentially like on a Fed tax return, you would see taxable income times the 20% tax rate, and that would be your tax liability. All the states work similarly to that, where they all have their own C corp tax rate and then calculates an amount due. I would say those are like on the easier side of business multi-state tax returns, just because there's no nuance with K1, state K1s or PITA or anything like that. It's more straightforward. So then S corps and partnerships are pass-through entities. So when we're filing states on these returns, we're issuing state K1s the same way we issue Fed K1s. So it'll have one for all the partners, it'll show their income allocated to that state, and it'll have like the payment that was made on their behalf if there is one. So with these payments, these states allow the pass-through to make a payment on the owner's behalf so that all the owners don't have to file in all the states that the business files in. So there's composites, withholding, and pass-through entity tax are the three different types of tax that can be paid on owner's behalf by the pass-through entities to states. So the goal with these is that all the owners don't have to file everywhere that the business files. And then also with pass-through entity tax, it's a deductible expense. Unlike withholding and composites, those are distributions. So that's not a P&L item, but pass-through entity tax is. So we're basically generating a deduction for the business by paying tax on the owner's behalf, which they would have had to pay anyway at the personal level. The business now gets a deduction for it. Any questions on that? So usually when we're in our software and we're doing this, there's like certain inputs that you have to check to get the software to calculate these, because it's not the default in most states. The default is no payment made for the owners, no tax paid on their behalf, so you usually have to tell the software to calculate that for you. And then some states have minimum fees. This is usually for like S corps and C corps, where even if you have a huge negative taxable income year, so you don't have to pay any tax on your owner's behalf because there's no income, they'll still charge you like a $25 or like $800 minimum fee just for the pleasure of doing business in their state. So California is the worst for this. So nexus is the term that basically we use to figure out where we need to file. So when we're looking at all the information that we get from our clients about where they're selling into, where they have employees, and where they have property, that's how we make a decision about if we need to file a tax return there or not. So the main two would be the physical presence of these property or employees there. So when we have employees in a state, obviously we have to, pay withholding on their behalf, file employment returns, that kind of stuff. So states will know that we're existing in their state because we're filing all these other things in the state. Same with property. Usually if you have property somewhere, you have to file like a PPT return, or, real estate information is pretty readily available. So if you have like physical items in a state, they usually are able to find out about that too. So when we have property or employees in a state, it's pretty much unavoidable that we always have to be filing there. So where it gets more gray is, so like the sales aspects of this is we could be selling like anywhere and states would never know. We can, like with online shopping and like that kind of stuff, there are a lot of ways where states can never find out that we're doing business in their state if we don't have any employees or property there. So obviously the states don't like this, so they're starting to pass laws where if you're doing like 500K of sales in our state, you have to be filing a tax return and you have to be paying tax to us. So that's what factor presence nexus is. So that's basically just the state's way of catching people who are doing sales activity in our state without actually having a physical employee or any property in the state. And that's like a state-to-state decision. That's in their statutes where they say if businesses are doing this in our state, they need to file returns and pay tax in our state. An economic nexus is the more broad version of this, where states don't give like a dollar amount or a threshold. They just say, generally, if you're doing substantial business in our state, you need to file. So that's kind of where the gray area comes in of where, like, what do you consider to be substantial? This substantial change based on the size of a company, that kind of thing. So that's the more gray area of whether or not we exist in a state. Affiliate and agency nexus isn't as common. That's more of like a consolidated C Corp or like bigger company issue where they have like lots of subsidiaries and lots of related companies. So it's, if you have like payroll under one company, are you obligated to file under a parent company and kind of that sort of thing. And then pass-through nexus. So this is something I think that trips a lot of newer preparers up, is when you have a return that you're working on and all they get is K1s from other businesses. How do we know when we need to file in those states? We don't have any of our own activity to figure it out, right? We don't have payroll property anywhere, so how do we know where we need to file? That's where the pass-through nexus comes in. So if we're getting a K1 from some other business and there's state K1s to like 30 states, there's probably a good chance we need to file in some of them. That's kind of a like return by return decision of where we need to file, but generally getting a K1 does raise at least a question of if we need to file in that state or not. Because obviously the state is getting that K1 from that business with our name on it. So like they know that we're here in some capacity. So any questions on this? Or should I talk through anything again?
Does Nebraska have a factor presence nexus?
We do not.
What are some of the more common places that you'll see that other than California?
So I think there's actually there might be a chart in here for this. Maybe not. So it's usually the more aggressive states. So there's kind of states that everyone knows are like more aggressive of going after taxpayers. So like New York is a common one. Minnesota, Illinois, some of these are kind of surprising probably, but like Iowa has a factor presence nexus. Yeah, it's usually the ones that we would generally consider on the more aggressive side. It's probably only like a third of all states that would have something in statute for factor presence. A lot of them, such as Nebraska, have the like, if you're doing a substantial amount of business, you need to file. But like, how are they gonna come after us for that? Like, they need to prove that we're substantial. Okay. So apportionment is how we figure out what piece of our total income is attributable to all these different states. So we've already figured out where we need to file based on where we have our property and payroll and factor presence nexus and all that stuff. So then the question is, how much of our income is taxable to those states that we have to file in? And that's where apportionment comes in. So it's essentially like a percentage calculation that the states do to determine how much of it they can levy tax on. So we kind of already talked about property and payroll and sales, I guess, too. So the way that states calculate this is they say, like, what's the dollar amount of payroll that you paid in our state versus your total payroll everywhere, and you get a percentage. Same thing with property, same thing with sales, and then divide that, add those up and divide by 3. And that would be like a 3-factor formula. However, a lot of states now are doing sales only. So they don't even take the dollar amount of property or payroll into consideration. They just want to know how much of your sales is in their state versus your total sales everywhere. I would say it's probably like 70% of states that just do it this way instead of taking the property and payroll into consideration. But the thing is, we still have to consider that for where we need to file, right? So even though the state is not concerned with it in calculating the percentage of income, we still need to know where to file based on that. So there's a chance we would have an employee somewhere and no sales, so that would be a zero apportionment state that we would still have to file in because they still know we exist. Does that make sense? Okay. Nebraska is a sales only state. Then there's in certain industries have specialty apportionment as well. So like if you think about like we have a lot of trucking clients, for example, how do you really quantify like how much business or how many employees are in that state when you're just traveling through? You're just driving through the state. So it's like, how do you consider like is this an employee in the state? They were there for 2 hours, you know, that kind of thing. So some industries have more considerations with apportionment where it's based off of mileage or it's based off of some other metric other than these 3 things. Okay. So like I said, a lot of these states are changing to only caring about sales. So then we have to think about how do we determine where our sales are? So what you first need to do is think about what kind of company you're working on. Like, do they sell tangible personal property? Are they a service business? Do they sell something that's in the cloud? Because that is how that's what we consider when we think about how much is attributable to each state. So like if you were just selling like, I don't know, beef or something, you source your sale to wherever you're shipping to. So we could be shipping out, you know, our items all out of Nebraska, but none of that would be sourced in Nebraska if it's all going to other states. So if all of our sales were being shipped to Iowa, we would have no sales in Nebraska because all of our ship to location is Iowa, not where we're shipping from. And that can be confusing for clients when we just generally ask for like, what's your sales by state? They're like, well, what are you asking exactly? Like, where we're invoicing to, where the customer exists, like that can kind of get subjective at some point, but the point is it's like the end user is where we would source that sale. So when we're thinking about our apportionment factor, we're thinking about the numerator of what is attributable to that state specifically, it would be wherever the customer lives, for example. Does that make sense? Okay, like I didn't say that very well. So then if we're talking about like services, so like accounting, legal, stuff like that, we have a completely different set of rules. So completely forget where the customer exists, all of that is only for TPP. When we're thinking about services, we have this concept called cost of performance and market. So cost of performance is where you're doing the service. So we do all of ours here in Nebraska. We're doing all of the accounting work in Nebraska. Market rule is where the customer is. So similar to TPP, market is where the customer is at. So states enact statutes where they choose to either be a market or a COP state. And this can get kind of confusing, so we can go over this again if we need to, but so Nebraska is a market state, for example. So we care about customers in Nebraska. We don't care about where the service is being performed. We care about who is receiving the benefit of our service. Kansas is cost of performance. So they don't care about who in Kansas is receiving the benefit. They care about, are you doing your work in Kansas? So there can be times based on this rule where a particular sale is being taxed in 2 different states because you're performing it in Kansas for someone in Nebraska. So it could be taxable to both of those states. And on the flip side of that, it can be taxable in neither. If you're doing it in Nebraska for a client in Kansas, then it's a wash. It doesn't get apportioned to either state. So again, what we're trying to do here is figure out the numerator of our apportionment factor. So we're just trying to figure out where are sales attributable to so that we can figure out how much of our income is taxable in a state. Should I talk about that again? Yeah.
What if you have like remote employees? How does that play with the cost of performance?
So if you have remote employees, you need to be thinking about the revenue they're generating in that state and that COP is to that state versus where your business is happening. But like with a lot of our clients, sometimes this data is like not super available, right? Like they don't necessarily know how much revenue their employee in Tennessee is generating. So in that case, we would just say it'll all go to Nebraska, whatever. How are they gonna catch us, you know? But in theory, you would need to figure out how much of your revenue is coming from that specific employee, and that would be the COP for that piece of the revenue would be Texas, and then wherever all your other employees would go to that state. But like for Nebraska, like we don't really care where it's being performed. We care about is it to customers in Nebraska. So like for a lot of our clients, the COP is Nebraska because they're based here, right? That doesn't matter. We only care about where it's going, not where it's starting. Feel like I'm losing everyone, Pete.
Well, let me ask a question. No, I don't. Actually, Kaylee, I'm going to give you a compliment because I think you're doing a very, very good job of breaking this down in a way that people, I think, can follow. Because I'm listening, and you aren't rushing through. You're breaking the pieces apart, and you're putting it back together for them. And I think she's doing a really, really good job. So, let me ask a question, though. If I'm a Nebraska company, and I'm doing work down in for somebody in Kansas, and I charge them $1 million. Based on what Kaylee said, where's that $1 million sourced?
Be both, wouldn't it?
Neither.
Or be either, because Nebraska's
Nebraska's market,
market.
Kansas is COP.
Okay, so if we're Kansas, if we invert that, and we're doing work for a Nebraska company, where's that $1 million sourced? Both. So what Kaylee's highlighting is, wait a minute, you really got to stop and say, where's the business located? And then you have to categorize the state in which the business is doing, conducting activity as cost of performance or market. And then you have to determine how that company is interacting with the clients in that particular state. I think that's what you said.
Yep.
And I think you did, actually, I think you did a very good job with that.
Would they be paying double tax?
Yep.
So are there a lot of businesses that like either physically locate in certain areas or like hey, I don't want to be in Kansas because of this, or like I would rather be somewhere.
This is also like a good planning opportunity when you think about us in the state and local department, like maybe we want them to encourage them to go after customers who are in COP states, because then we're at least avoiding double tax, if not completely avoiding tax in general. So it's a good opportunity for us to think about where we can encourage them to move into, or if they're thinking about a new location, we can say, this is something you need to consider if you move there, that kind of stuff. Yeah.
Are they allowed, or are businesses allowed to raise prices in certain regions to cover that?
Ooh, I don't know, probably. They do what they want.
It just feels weird that the government would leave a path open.
So one of the charts that's at the back.
You have a market versus cost.
Yeah, so if you guys want to flip, it's like the last chart under the state tax section. That is market-based sourcing. A quarter of the way down the page. And it's just a grid here that shows, it says yes if it's a market state. So we can kind of flip through and see how many of those are market, how many are COP. It's majority market. If we think about the country as a whole, it's much more market than COP. So, kind of like Pete was saying, if you're starting a return and you recognize this is a service business, and you ask for your sales by state, am I not sharing now?
Yeah, you should be.
Okay. So, in general, a lot of our clients are Nebraska, right? So our COP is Nebraska. And then we ask for sales by state. So they're going to be sending us a list of where all their customers are located and how much they charge them and what their total amount of customer revenue is in each state. So you can go through each of those states and say, is this market or is this COP? If it's COP, we can throw all of those sales out. Like, we don't even have to think about those because our COP is Nebraska, not those states. We're located here, so that's where our COP is considered to be. But then for all of your market states, those we have to source sales to. So we have to include that in our apportionment factor. That is part of what ends up being taxed at that state.
Okay, so I want to do something. You can tell me where I go up. Think, did I do this last time?
Yeah,
I think this is
useful.
useful. Do you
Yeah.
not?
You can do it.
I mean, from the standpoint, I think what you said, Kaylee, is that in determining where your sales factor is, you have to first take your sales and determine whether it is tangible or service, correct?
Yep.
So as a staff person, your first categorization is what kind of client am I dealing with? Tangible or personal? And if it's tangible, it is where's the client?
Yep.
Okay, I think is what you're saying. And then for service, it is
It's where's their client, not where's Walt client. Where's their customers.
how's that different?
Well, I don't want them to think we're talking about like our client. Like, where's our client located? We care about
Yes.
where's their client.
Yes.
That's a good distinction.
Yeah.
Okay, so where is the business's customer?
Yes.
Is a better way of saying that.
Yep.
Okay. Then on the service side of things, I think what she's saying is, you have to identify is, well, probably three things maybe. Where are you located? Okay, so where's the business located? Where is headquarters? Fair enough?
Yep.
And then once you have that, you have to say, okay, where are they doing business? And is it a cost of performance location or is it a market location? And you have to ask the same question, is this a cost of performance or is this a market?
Yep.
So this is going to help you, Sam.
Diagnose.
What are you diagnosing? Exactly. Where the sales are located. So going back to back to her apportionment factor, the sales, we got $100 million of sales. And if it goes this direction, right, to the tangible side, and we know we have customers in Colorado, New Mexico, New York, and Texas, and in Kentucky. Okay? The $100 million, and every customer is buying equally from us. Well, you have $20 million of sales that's going to go to Colorado, New Mexico, New York, Texas, and Kentucky for your apportionment. So now you can figure out what amount of income is going to be going to that jurisdiction.
Yep.
That, to me, even this simple brain can wrap its head around that. Okay? But if you go down this side, it's service. You have to say, well, where's headquarters? Well, it's in Nebraska or wherever. And you have to figure out whether it's cost performance or whether it's market. And then you have to say, well, where's my customer? So now I got this $100 million that's being generated by headquarters. And if it's cost of performance state, then I got to figure out the $100 million, how much, I'm going to say 50 million is in cost of performance states, and 50 million is in market states. So cost of performance, it says, well, was the cost, did I sit in Nebraska and do everything, and the cost of performing that duty or that service was all Nebraska? Well, in that case, all of it's going to go to the headquarters because that's where the cost of performance was. But if it's Colorado, New Mexico, Kentucky, Texas, and New York, whatever, then that 50 million, because this cost to perform that service, to render that service, I got people on the ground in those states, That 50 million has to go there, to those states. So now you have to ask your question, where am I headquartered? And if it's cost performance, are the people on the ground in Nebraska or where the headquarters is for this side of the tree, or are they in these 5 states rendering the service? And the answer to that question is going to be informative of where you shove that 50 million for purposes of apportionment. In market, it is, where's the customer? It's the same thing as over here, correct?
Yep.
So, did I do that last time?
Yes.
Oh, all right. I think it's
Not this exact, but
something.
So let's say you work in Nebraska and you were like going to a cost performance state, none of that's gonna be taxed.
correct.
Got it.
So what you first need to do when you're working on a service is say, where's this business located? 9 times out of 10 will be Nebraska, but let's say it's Kansas. Then all of our business that we're doing is taxable in Kansas. 100% of it is because we're doing all of it there. And then we have to look at our customer list, or usually a client will just give us like a sales by state that'll summarize that for us. And we'll look at the list and say anywhere that's a market state, we also have to report details to those states based on how much business we did there. So in that case, everything gets double taxed if you're located in Kansas. So it's actually beneficial to be located in Nebraska under this concept because all of our COP is here, but none of our COP sales are taxed here because we're a market state. Yeah.
So does it matter if like a certain percentage of the work is done in one place versus the other? Because like for example, like I worked at like an accounting firm in like a small Nebraska town one summer, and we like would go out to like tiny banks and tiny towns and like do like their audit or director's exam or whatever. And so like we did 1 or 2 in Kansas, but it's like we'd be working on it in the office in Nebraska, and then we'd go down there for like 3 days, and then we'd come back and finish it up. So like, does that change anything?
So this is actually like a more complicated apportionment subject. For project performance, it's where the majority of the work is completed. So I think in your case, as long as the majority of it is being done in Nebraska, it would still be a Nebraska sale. But like, that's where it also gets subjective. Like, what is the majority? Like, what would be considered the majority of the work? So that's where, like, these things can be kind of gray. It's like, where would you consider to be the majority of the work? Is being in front of the client the majority, even if you spend less hours there than somewhere else? So that's where it can get kind of dicey. But to keep it simple today, COP is where we're located in general. And I can even show an example of this when we get done of like a client's work papers when we're determining COP market stuff. Okay. So actually want to get out of here. So this is our general formula when we're thinking about state tax returns. So most state tax returns will start with the starting point of federal taxable income or federal ordinary income. So that number can be found on the Fed return and it just carries right to the state tax return. Then we have our adjustments. So we haven't talked about this yet, it's the next slide, but certain states don't conform with certain aspects of the Internal Revenue Code. So states can decide if they want to conform with the code as of a certain date, or if they just want to always conform to the code no matter what changes or what goes through it. So Nebraska is one that just always conforms to the code no matter what. But for example, like Illinois conforms to their Internal Revenue Code prior to when we started doing bonus. So they don't allow any bonus depreciation. So then when we're looking at our Fed taxable income, that includes a bunch of bonus. So we need to add a lot of that depreciation back on the Illinois return because they don't allow bonus depreciation. They only allow makers depreciation. And the same concept goes with like state income taxes. So on our Fed return, we're probably deducting a bunch of PTED. And a lot of these states say you can't deduct that in a state. It's redundant. Like it's literally deducting to find new tax. So and like certain states like Nebraska only add back the Nebraska tax. So on our P&L, if we have like 20 grand of state tax that we're deducting to get to federal income and 5 of it is Nebraska, we don't have to add back the whole 20, we only have to add back 5. So we would start with our Fed taxable income, we'd add $5,000 to it, and we get our state taxable income. Then that is times by our apportionment factor, which we just talked about a bunch. We get to state taxable income times our tax rate in the state, and that's where we get to the tax amount. So I kind of wanted to show this in a return so you can actually see how this flows through on a form. So this is one of our really big multi-state clients. So we'll just go to like Idaho. Okay, this is what the Idaho tax return looks like. The first line here, ordinary income from our Fed return. So you can find this number on page 1 of the Fed return. And then we have our Schedule K items, so eventually this gets us to our state tax. They just divvy it out on the Idaho return. So then they don't allow us to deduct any of our state taxes that we're deducting on the Fed return. So we have to add back 2.5 million of state taxes. We must have had not a lot of ads this year, so we actually have a subtraction for bonus depreciation. So this is kind of confusing, but so let's say you had a bunch of ads last year. So you took a bunch of bonus on it, and all of your depreciation is used for all those assets that you added last year. Now this year you don't add anything, but these states are still allowing you to take 5-year or 7-year makers on those. So you actually get a deduction this year instead of an add back because you took all of it for Fed purposes last year, but you still have a whole like 4 years of it to take at the state level. So that's why it's a subtraction here. So then at the end of the day, after we do all of our adjustments here, we get to the taxable income for that state after adjustments. And then we take it times our apportionment factor. And then that's taken times their tax rate, which is 5.8% right here. You can see we made a payment at some point, so we end up with a refund. Does that make sense? So it's just kind of showing how that whole formula works. And this is generally how every single state will be presented. Like the form will look different, it'll have different add backs, different subtractions, but at the end of the day, this same formula is generally what every state is going to follow. And this is their apportionment form. So what we just spent all that time talking about, you can see we have property here. We have a bunch of property, but none of it is in Idaho. So we have 0% of our Idaho property. We have some sales here. This is our sales that are attributable to Idaho. We have a percentage of that. Same with payroll. So then they add all of these up. And at the end of the day, this is our apportionment that is taken times our taxable income to get to an amount that is apportionable to that state. Should I run through that again, or are we good? Good, okay. Okay, so this is what I just talked about the state adjustments. So just when certain states don't conform to things that are in the Internal Revenue Code, that's when we have to adjust at the state level to get to the right spot. So the most common one that we see is bonus. There's, I don't know, 40% of states that don't allow you to take bonus on them. So you might have a huge loss at the Fed level because you took a bunch of bonus depreciation, but if we add that all back at the state level, you might end up owing there, even if you had a huge Fed loss, because they don't allow you to deduct all of that depreciation. They only allow you to take a bit of that or whatever. So that's a really common one. The state tax one has been more of an issue now that Nebraska enacted it with their own personal. So a lot of states don't allow you to deduct any state taxes. So now that, you know, we had everyone pay like a huge amount of Nebraska PTED last year, well, that all is going to get added back in all these other states. So if you paid like 2 million of Nebraska PTED, we're going to go to file our Idaho return and they're going to make us add 2 million to our taxable income when we are trying to arrive at our Idaho income. Oh. Okay. So that's kind of all of the business aspects that we're going to talk about today. Is there anything that anyone wants to go over again or questions on anything? There's a bunch of charts that are at the back that are basically showing like which states allow bonus, which states allow 179. The market COP one is in here. That's what the last like 30 pages of this probably are, just charts that show each state and what their rules are for different conformities. Then I wanted to highlight this page. They're like not numbered, but it says state tax preparation training fall 2024. Looks like this. It's right after the PowerPoint in here. But this is like a manual basically to getting around in access to prepare state returns. So it's a few pages long and it has all of the tasks for how to get around in access to do your state tax returns. So how to input your apportionment, how to input your adjustments, all that kind of stuff to be able to prepare them. So this is something that I would keep close when we get into busy season and you start preparing these big multi-state returns and you don't know where something goes, you can refer to this and it should help you.
Kayla, you talked about the non-Nebraska LLC and S Corp and credits for state
That's
tax.
failing, yeah.
Okay.
Okay. There's also, after that little manual, there's a map that shows where all the states that have PTET. It's in black and white, so it's not super helpful. Because you can't see the color coding, but
Kaylee's going to email you that map.
yes, I can email it to everyone. It's just a general map. You kind of get the gist here of all the states that have enacted PTET, and it's pretty much all of them. There's like 2 that haven't. So, I guess they're also listed off to the side. So, even though you can't see the color coding, it is on here. So, passenger tax is something that's fairly new. States just started enacting it maybe like 3 or 4 years ago. Nebraska just jumped on board last year. We've had composite and withholding options for a long time, but states being able to pay on their owners' behalf and deduct it is pretty much a last like 5-year development. So that's what pass-through entity tax is. And that's very, very important when you're preparing. That's something that will always matter. Keep my Zoom ended.
Do what?
Do I just need to reshare? You guys enjoying this?
Okay.
Anyone interest really peaked? We have room on the team. Okay. So we just spent that whole time talking about businesses and how businesses figure out where they should be taxed and where they should be filing, but we also have all of our individuals who are getting all of these state K1s and have all kinds of activity in various states. So what do we do when we get into like a 1040 and they have multi-state activity? So something that we see kind of often is when someone, for example, like lives in Council Bluffs and works in Nebraska or something like that. So at the bottom of a W-2, you can usually see where there's like an amount taxed to each state. So it'll say like Iowa taxable wages withholding, Nebraska taxable wages withholding. So those are cases where someone might have to file in multiple states. You just have to be paying attention to W-2s to catch that one. Schedule C, I don't feel like is super common. It'd have to be a pretty large Schedule C, but they very well could have sales in multiple states. I would say you should be able to tell from last year if we asked for like sales by state for a Schedule C, but 9 times out of 10, Schedule C is not an issue with multi-state things. Rentals and farm are a little more common. So like you might live in Nebraska and own a farm in Kansas, or you might have a rental in Arizona or something like that. So any income that you're making off of a farm or a rental that's not in Nebraska, we have to be filing a return in those states and paying tax to those states for the income that we're earning there. Because we physically exist there, right? We own a house there, we own land there, or whatever. So we have to be paying tax to those states. And then K1s is the one that we see the most. So we file that business return, we figure out where all the sales are attributable to, and then we kick out a K1 to our owners, and there's like an Idaho K1, a California K1, all that stuff. So what you have to do is look through the K1, see how much income is on that specific state's K1. So you would get into your California K1, look at the column that says California source income, and determine if you need to file based off of what's in that column. So there might be like $2 in there. Well, we don't care about that. We're not going to file in California for $2, even if they want us to. So you have to make judgment calls on these returns. But usually, a manager will tell you if it's like $1,000 or less, we can ignore it. We don't care about it. If you think about it, $1,000 times like a 5% tax rate, the state is probably not going to come after us for $50. And if they do, we'll pay them for it. That's pretty minimal. So Have you guys, I'm assuming most of you guys have seen like multi-state K1s, what that looks like, yeah. So what I just said, a material amount is where we start carrying. So if you get a K1 that has 20,000 of income to Idaho, we probably need to file in Idaho. Potentially, if there's a PTEP payment on their behalf in that state, we don't have to file there either. Even if it's a big amount, we don't care because we already made a payment to the state, so the individual doesn't have to file there. That's 9 times out of 10 what you're going to hear. If there's a payment that was made on the owner's behalf, we can ignore. Don't need to worry about it, no matter how much income is on the K1. That's what I just said. Okay. So Nebraska has kind of a unique rule for individuals. So, again, when we're thinking about these state tax returns, we start with our federal taxable income. Well, if we're a business and we're just reporting our total amount of income, a lot of that is not Nebraska. It's sourced to other states. We paid PTED to them. We're not filing there, but that doesn't mean we have to pay tax on it as Nebraska residents because it's not sourced here. So we get what's called a non-Nebraska adjustment. So on our Nebraska 1040, we get to back off the amount of income that's attributable to other states. So it's literally just like I showed you guys with the adjustments, very similar, where we start with our federal income and we get to just subtract out all of the income that's not related to Nebraska. So I can open up the K1. And I'm sure most of you guys have already seen what these look like, but okay, so I was just showing you guys the return for Atlas that files in a bunch of different states. So if we look at the Atlas K1, this is our total income. So on our Fed return, this is what's going to be getting taxed. But a chunk of this is not Nebraska income. It's to all of these other states that Atlas files in. So Nebraska says, you guys don't have to pay tax on that. We know it's not from here. So on our Nebraska K1 then, there's this line that is showing how much is not related to Nebraska. We get to just completely subtract that, don't have to pay tax on it in Nebraska. This only works if it's an LLC or an S Corp. So if it's a general partnership or a limited partnership, you don't get this adjustment. You only get this if it's an LLC or an S Corp. So like in this example, 362,000 is not Nebraska income. And our total is 365. So only 3,000 is taxable in Nebraska, where if we don't put that adjustment on the 1040, they're gonna get taxed on that whole amount versus like $3,000. So that's why people really harp on getting that non-Nebraska adjustment right, because it can make a huge difference on our state return. And then I can show where that goes to. So then if we look at this guy's Nebraska return, so this is his personal 1040 Nebraska return. This Schedule 1 is where that number is. And you can see this is 26 million. That we're saying this is not taxable to Nebraska. So we report this on this line. And then on page 1, it's backed out on this line. Adjustments decreasing federal AGI. So like I said, we start with our Fed income, make some adjustments, we get to a Nebraska amount. So, I mean, this guy has a ton of federal income, and we're negating most of that for Nebraska purposes with that non-Nebraska adjustment. So that's why we care about that. And not every state has something like this. This is pretty unique to Nebraska.
Do a lot of states rely on that credit for taxes paid?
Yep. So instead of having this, what a lot of states have instead is a credit that you get to take against the tax paid to other states. So it's like I paid $1,000 to Minnesota. So when I look at my Nebraska tax that I owe, if I owe $10,000, they say you can take that $1,000 off and just pay us $9,000. You already paid one somewhere else. Which Nebraska does also have that option. It's just almost never as beneficial as using this adjustment instead. the credit for tax paid is usually only used when it's a limited partnership, because like I said, we don't have the option of doing this with partnerships, so then at that point, we would have to calculate a credit for tax paid, but that is the norm in almost every other state to do it that way.
So the comment would be if all the business was being conducted in Texas, there is no credit for state tax paid, but there is a deduction for the LLC. And the second thing is, it's a double-edged sword, because the non-Nebraska S Corp adjustment can be positive or negative. You can have a loss somewhere, and pretty soon you're adding back income. And one of the things that, if I know that I'm dealing with a startup, somebody that's going to run losses for 5 years, guess what I tell them to be? An LP. Because an LP, I can use that loss now for Nebraska's, because there's no non-Nebraska add back associated with that. And then when they turn profitable, it's time to go to LLC. Because now I can exclude that income from Nebraska.
So this schedule 1 that shows our adjustments, part A here is increasing our income and part B is decreasing. So like Pete said, there is an option here, line 8, where we are increasing our income because we took a huge loss at the federal level, but none of it is Nebraska. So we have to add that back to our Nebraska return. So that's something that people do not like to put on the return. But when it looks like this, people are a lot more excited about it. Okay. So I think we're close to being out of time. I don't know.
I don't care about that.
Okay.
I mean, we're here not on time limits for quality. So if you have stuff to say, you're going
Okay.
to keep going.
Would you guys be interested in me showing you around in the software a little bit for where these things go? Okay.
And as an estimation, 10 minutes, 15, 20, half an hour.
We just do like 15.
Okay, I'm gonna tell Zach 20. You look like you're lying.
We'll just open this one up. Another thing for everyone to be aware of, if it's a big multi-state return, the access file is going to be slow. Like it's gonna take forever to calc, it's gonna take forever to print. So when you're thinking about like a budget, assume that you're gonna have a lot of time of like the return just recalculating. That's how bad it is. Want everyone to know. So I'm opening up Atlas, which is the return I was showing you guys just in the software now. So when we look at our forms here, obviously we have our Fed return. And then here's where we have all of our states. So Atlas files are pretty much everywhere. When we're thinking about apportionment, so this is where we're getting our sales by state, our payroll by state, that kind of stuff. That's under this common state / city allocation and apportionment. And this is in the like guide thing that I was telling you guys about. But so you can see we have all of our different factors here. You can input it by state sales that we have there. There's a total at the bottom. So this in theory should tie to like your line 1 of your tax return. So we want to be accounting for sales everywhere, or we want to be putting it in other. So if it's like a market COP, for example, and we have a bunch of sales that aren't taxable anywhere, we still want to be putting that in the other box so that our total sales are still correct. We just don't want them to be taxed anywhere. So in theory, this amount should be able to be found somewhere on the Fed return when you're doing this. There's a lot of times that clients give us information that doesn't match the Fed return, and then we have to do a plug or we have to allocate it proportionally. But when we're putting it into the software, these numbers should be able to be found on the federal return somewhere that we're tying out to. I want to highlight this box. So this is under that same common state city. This zero apportionment assumption when state factor is blank. So let's say that we have a market COP situation going on, and when we fill out our sales by state, we don't put anything in for Kansas because we're not apportioning any sales there because they're a COP state. Well, if we don't check this box, Kansas is going to say there's nothing in our input, we're taxing everything. So it's gonna be doing 100% of your sales, even though you didn't put anything in that box. So when you check this box, we're saying if there's nothing in the box, the answer is 0, not 100. And this is somewhere different on a, so this is an S corp return. On a partnership, it's under the allocation and apportionment. It's just like a 6th tab that you have to check, but it looks the same as this. When we're generating states, that's under here too. So let's say you have new payroll in a state this year and we need to add it to their return. You'll go into this state city generation box and you just check generate tax return or wherever it is. If we are electing PTA in that state, you also have to go in and indicate that, because like I said, the default in the software is not to be making a payment, it's to just be pushing all the income to the owners. So you have to go in here and indicate that we are going to be paying PTA there, and that's how you get the calculation of the tax to come up. So without checking this, it's just going to be calculating taxable income and pushing it out on K1s without owing any tax on it. What else? State city common data is under here too. So this is where you would indicate if you if it's a new state, so you would mark it as initial if it's new. That's kind of more important than you might think, because if we don't indicate to a state that it's our first time filing there, they might come after us and say, we need tax returns for the last 3 years because you didn't say it was your first year entering the state or whatever. So we want to be marking them as initial returns if it's our first time filing in those states. I know you guys are probably aware of the terrible state diagnostics that take forever to clear, and there's a million of them. A lot of those diagnostics can be cleared somewhere in this page. So a lot of times people, like there's somewhere on the form that you have to disclose who is in charge of the books or something like that. That's always in here. There might be something you have to input up here, some kind of informational item that they want. A lot of those are cleared under this general information state city common data area. So if you're ever lost on how to clear a state diagnostic, there's a good chance the answer is somewhere in this page. There's also, just on our basic data page, there's this box that says confirm accuracy of data transferred from prior year. And you can see all the states that are listed out on here. If you check this box, it would probably like half the amount of diagnostics that you have. So checking this on a multi-state return will always make it better as far as the amount of diagnostics you have. So if we have payments on a state, it's under the federal inputs, it's not under the specific state inputs. And it's just here, state quarterly payments, and then Atlas files in a handful of cities as well, so they have those too. But
did you just say the state payments are in the federal inputs?
Yeah.
That is exactly why I think this is the world's dumbest software.
you missed the part where I was talking about how long it takes to recalc a return when it's a multi-state return.
Yes.
So when you're doing this, you just put your state code at the top, and then this is where you would put in estimates. So this is what we paid throughout the year. If we have an extension payment, it goes in this box, amount paid with extension. Right here. There's some states that are kind of tricky. I would refer to like these codes a lot that are in parentheses here. Like if you can't figure out how to get a payment to show up on the forms, sometimes it lies within these inputs, other extension payment, additional extension payment. You have to use these boxes instead. But yeah, whatever's in parentheses here is usually pretty helpful as far as like getting things to work, show up where you want them to. And then all of the states also have their own individual inputs. So this is where a lot of those like adjustments would be. So for example, I was showing you guys Idaho where we have a depreciation adjustment. So if we go into our specific Idaho inputs here, we go to income deductions, we can see that same adjustment that I was just showing you guys on the forms. So a lot of times those adjustments have to be manually input state by state. So when it's a big multi-state return, that's going to take a lot of time. So when you're thinking about your budget, that's something that's going to be a little more time consuming than like putting in payments that are all on the same screen. There's also usually some kind of general screen for all of these states where maybe there's like a random box you need to check, or there's something that you have to input from last year or something like that. So That's another place if you need to clear diagnostics, there's always some kind of input that you have to have in the general place as well. When we're talking about states, generally we want to e-file everything possible so that our client doesn't have to come in and sign a million tax returns. So that's why we're encouraging diagnostic clearing. So at least if it's e-file diagnostics, try to get those cleared. But if it's like we're missing a state ID number or because of our entity type, we can't get it to clear, you go into e-filing and state e-filing options, and you just put in no if you can't get it to work. And then the software will change the instructions for the state to show where to mail it to, where to sign on it, all that kind of stuff, instead of just saying your return has been electronically filed. But in general, we want to always be e-filing wherever we can, because we don't want our client to have to come in and sign 50 returns, nor do we want to mail 50 returns out. So then I'll just do a quick plug for the state tax summary. So this one is going to look kind of scary. I don't want it to intimidate you guys. So this is everywhere that we filed for Atlas. And when we're thinking about work papers, so I know you guys are accustomed to having all of your Fed work papers in here. The state ones are always at the bottom. It's the 900. So you can see like our apportionment work papers here. We have our adjustments. We have our payments that we made so far, all that kind of stuff. 900 state tax summary. So this is a list of all of the returns that we're filing, whether they're e-file or paper, what our liability is, and payments that we make, and the ending balance due or refund on the return. So this has to be filled out for every single return that's over like 5 states. And you have to fill this out manually, and it takes a long time to do as well. So just be thinking about these things when you're working on state returns, be figuring for some time to go through and fill all this stuff out. Basically the reason we have to do this is so we can give our clients like a succinct summary of where they owe and how they need to pay it, where they need to mail the return and all that kind of stuff. And then also for admin to know what needs to be e-filed versus printed and all of those processes. So it's a pain. We're working on improving it. We're trying to make it better. But assume that you're probably gonna have to do this for any 5 or more state return that you do this business. And please consider all of the columns, not just the main like 10. Think about like over here we have all of our different payments that we made by partner. That we use this to create a footnote so that our like when we're preparing the 1040, we can easily see everywhere that there was a payment so that we don't have to figure out what we're gonna file manually, it's already in there. So just be thinking about all of these different columns. We have payments by partner, we have estimates for next year, so this would be like 2024 payments that we're recommending that they make before year end. And then this is like the main section for this year, so it has our liability, overpayment from last year, estimates, all that kind of stuff. And then yeah, we have our e-file column, and then payment method is just saying if there is a balance due, how is the client being instructed to pay it? Are we sending them to pay it by check? Are we making the payment for them? Do they have to go online and pay it? That kind of stuff. And that'll be on the instructions of the return. So if we look at like Atlas, for example. So Idaho has, each state has like a cover page here of basically summarizing what you need to like put into the tax summary. Like if we look at Idaho, it's an e-filed return. This return is qualified for electronic filing. We have our tax, payments, overpayment, credit. It's being credited to next year. So this is all the stuff that you would be putting on the state tax summary.
Show that specifically on, is this same one, just to correlate it?
So our tax is 43,418. So we find Idaho. It's right here, 43,418 right there on the summary. And then we follow through, we can see, God, like
You
8,000.
do control and then scroll up.
It doesn't work.
Does it?
No. Oh, there we go. Well, no, I lost my Idaho line. Okay, it's right here. 6,582 negative. So we're saying it's not a balance due, it's an overpayment. And then in this column, we're saying we're applying it to next year. So if we go on the instructions here, 6,582 applying to next year. So that's a good way to check in the software to make sure that your tax summary is accurate, is to go through all of these instruction pages one by one and make sure that it matches with what you typed into your state tax summary. And in the software, if you go to,
At the end of the day, that is going to be right, correct?
yes, the instructions,
No, the tax summary.
the tax summary needs to be correct, yes.
Okay, and if it's not, it's a pain in the butt.
Yes,
And if they aren't doing that correctly, they're just shoving work onto you and burdening you when there's 30 of you and one of you. That work shift is very, very difficult for you, I presume.
Mhm. Yeah.
So what you guys need to do is get that right. And all that is data entry into a spreadsheet. And on a scale of 1 to 10, 10 being the most aggravating, 1 being the least, how much aggravation is that to them?
very low, I would say.
Okay, very little. To you, it's a aggravation.
Sure.
Okay, so do your job and do the data entry, make her life better.
And just as like a time saver, instead of like clicking individually on each one, you can go to review in the tax software and click letters. And this is what I'm talking about it being really slow when it's a big multi-state return. But if you click on letters, it'll pull up all of the instructions and you can just tab through each one and check it with your spreadsheet versus like clicking or having to scroll through a bunch of pages. So this will just pull up all of your instruction pages in a row. You can just tab down or whatever and look at all of them. So see, it looks like this. You can literally just go like one by one here and scroll through and make sure this ties to your tax summary. And especially with these like really big multi-state returns, like getting the tax summary right is very important to us because that's a lot of data that we need to be thinking about every year. That's a lot of returns that we need to be accountable for getting filed and getting payments made and all of that kind of stuff. So getting the state tax summary right, being able to refer to it next year when we're getting into returns is very important. So, and like Pete said, if I have to make a bunch of changes to the state tax summary, that takes me a long time to do. Anything else that anyone wants to see that we should go over again?
And